Hello and welcome to Street Signs on Fed Day. Our first and only mission today, the Fed, the economy, and you. The Federal Reserve's Open Market Committee winding down its two-day meeting on interest rates. We're going to find out what Fed boss Ben Bernanke and his colleagues decide in roughly 15 minutes. First, let's take a look at the key issues involved in this decision. And for that, we go straight to senior economics reporter Steve Leisman. Steve.
Thanks, Aaron. For a meeting where there's general agreement about what to do today, there's likely to be plenty of strong disagreement behind the scenes about what to do in coming months. Debate number one. Inflation is running outside the comfort zone, and there's uncertainty about the right monetary policy path to bring it down. How long will the Fed tolerate current inflation levels? Debate number two. The economy had been projected to slow. The third quarter looks likely to be among the softest in years, somewhere between 1% and 2%. But growth in the fourth quarter and 07 looks set to strengthen, at least to trend of 3%. Debate number three. Housing weakness was expected to spill over into the rest of the economy, but so far there's been little impact on consumer spending. Debate number four. Oil prices were falling, which is good for inflation, but Goldman Sachs estimates that will put some $90 billion back into consumers' pockets. That could boost growth in coming quarters. The result, an unusually wide range of forecasts for the outlook for the Fed. While the Fed is expected to remain in neutral today, Wall Street investment houses, they are sharply divided on the future. Some dot banks see the Fed going to 6%, others to 4%. The former Federal Reserve Governor Lawrence Myers says concern about inflation will prevail. It's now running as much as a half point over the so-called comfort zone, so the Fed will be quicker to hike than it will be to ease.
I think where the people who are expecting an ease quickly are wrong is that the slowdown underway is welcome. It's the elevated inflation that's unwelcome, and that what means that there's a high hurdle for a quick easing and a much lower hurdle to get back onto the tightening path.
So while it's a pause for Ben Bernanke and company today, it will be a restless pause. The Fed has one eye open and a finger on the trigger to hike rates. So the keys to the statement: does the Fed upgrade the growth outlook and downgrade the forecast that slowing growth will handle the inflation problem? Does it note that housing has not spilled over into the economy, or does it leave the statement unchanged, simply changing the date? Does Richmond Fed President Jeffrey Lacker dissent again, and does anyone join in? We'll be watching those things closely today, Aaron.
All right, that's the key here. Jeff Lacker, the lone wolf for two meetings in a row, dissenting, saying they should be hiking. Is anyone going to join him, and who? Well,
I think there's two questions here. One is, if I was Ben Bernanke, if I were...
The Dow down 26, NASDAQ and S&P higher, the yield on the 10-year 4.80. We're going to take a break, and up next, we're going to count you down to the Fed decision with our roundtable of experts. We'll be right back.
Maria Bartiromo in China reveals how the merger of capitalism and communism is creating investment opportunities for you. Changing China, risk and reward. Closing bell tomorrow.
All right, we are standing by for the Fed's latest decision on interest rates. Let's bring in our esteemed panel of CNBC expertise. Senior economics reporter Steve Leisman, still here. From Washington, CNBC senior analyst Ron Insana, Bob Pisani at the Big Board, and Rick Santelli on the bond market at the Chicago Board of Trade. Bob, first let's go to you and set the scene from Wall Street.
You know, I'll tell you something that's interesting. Wall Street, I'd say 80% of the people I've talked to today and in the last couple of days haven't felt the Fed are going to do anything that's going to affect the stock market at all. But there's a small group, 20%, Aaron, and I think they're the important ones that think that there's a little too much complacency on Wall Street about the Federal Reserve these days. Wall Street's fixated on the earnings and this tremendous move up that we have seen in the market in the last few months. The S&P is up 12% in the last 3 months. That's a big move. And any kind of interesting move here by the Federal Reserve or any kind of comments that are aggressive, particularly on inflation, are going to upset the apple cart a little bit here. So the key watchword down here amongst the small group is don't be too complacent. Aaron?
Rick Santelli, complacency in the bond market?
You know, I would have to say no, and we were just discussing that. Many traders believe that the big bounce that we've had pushing rates anywhere from 25 to 30 basis points higher than their best levels on October 4th is pricing in this new notion that revisions in growth affect the remission.
It is unchanged. Repeating, the Fed funds rate is unchanged. The Open Market Committee keeping the target rate at 5.25%. FOMC saying economic growth has slowed over the course of the year, partly reflecting a cooling off of the housing market. Going forward, the economy seems likely to expand at a moderate pace. Readings on core inflation have been elevated, and the high level of resource utilization has the potential to sustain inflation pressures. However, the FOMC says inflation pressures seem likely to moderate over time, reflecting reduced impetus from energy prices, contained inflation expectations, and the cumulative effects of monetary policy actions and other factors restraining aggregate demand. Nonetheless, however, the committee judges that some inflation risk remain. The extent and timing of any additional firming that may be needed to address these risks will depend on the evolution of the outlook for both inflation and economic growth as implied by incoming information. Jeffrey Lacker remains the lone dissenter. He, the FOMC says, would have preferred a 25 basis point increase in the Fed funds target rate at this meeting. This is Hampton Pearson reporting live at the Treasury Department.
All right, well, you just heard it from Hampton. An unchanged Fed at 5.25%. And crucially, in terms of the discussion on inflation, absolutely no change. In terms of readings on core inflation have been elevated. Inflation risks still remain. And also, the crucial thing we were watching for, still one lone dissenter who wanted to raise interest rates, and that was Jeffrey Lacker of the Federal Reserve Bank of Richmond. Market reaction for you quickly. Coming in, we were down 30 points on the Dow. Right now, off just about 11 points. S&P was higher by about 1.6. Little change there, still up 1.2. And let's show you that 10-year, give you the benchmark reaction in the bond market. We are at 4.806 right now, coming in at 4.804. So certainly not a lot of movement there in the bond market. So let's find out first the significance of the statement itself with Steve.
Very little change, Aaron, as you said. There is one slight change, and that is in the assessment of growth. They went from moderation in economic growth appears to be continuing to economic growth has slowed over the course of the year, partly reflecting the cooling. Going forward, the economy seems likely to expand at a moderate pace. And let me tell you, Aaron, the Fed watchers will have a lot of fun with this. Did the Fed do as I suggested it might? Did it slightly upgrade the outlook for growth compared to what it was? We're going to talk about this issue. Seems likely to expand at a moderate pace. Does that mean below trend, at trend, slightly above trend? There's the debate for the coming weeks.
All right, the debate is now playing itself out in the bond market, which Rick Santelli appears at this point to be an utter draw, because now we are virtually unchanged, actually exactly unchanged since the decision.
No, that's absolutely correct. It is virtually unchanged if you look at the coupon curve, but there are some interesting aspects. The Fed funds futures pit is still rather well bid, even though it isn't aggressively trading. Eurodollars are holding on to some of their gains that they really had, and that's a 90-day rate due to weak existing home sales. And we do see some buying starting to trickle in. As a matter of fact, we are now moving to the highs a day in the 30-year, in the 10-year, all maturity. So you're going to start to see those yields move a bit down.
Yep.
As we talked about, nothing really changed. Still a focus on inflation and growth, but it really seems to be priced into the bond market. Remember, we're not at a 4.56 10-year note yield anymore. We're at 4.80, so there seems to be a little bit of a rally ensuing.
Ron, you were talking about how your big concern was upgrading the risks of inflation, and as Steve said, it looks like what they did was maybe upgrade the growth outlook a bit.
Yeah, and that's you know, as unusual as it may seem, I agree with Steve on this 100%. That there was some language change with respect to the prospects for growth, and I think, you know, I don't think that necessarily guarantees, you know, a rate hike. I mean, the Fed, in my view, should probably stay on hold for quite a long time. But this upgrading does give them some latitude if the data were to come in stronger than expected in any conceivable way, or if the core CPI continues to move up, or the PCE deflator, the Fed's favorite inflation measure, continues to move up, then it gives them some latitude to raise rates again. But it does seem a little bit, a slight bit more hawkish than their prior statements.
Ron, I want to return the favor and agree with you completely on that. I think it does give the Fed the latitude here, upgrading the growth outlook to saying expand at a moderate rate.
Yep.
It leaves a key question unanswered, though, which is at what rate is the Fed see the economy expanding, and what is the potential of the economy? This big issue about how much slack is out there is going to remain the critical one, and I can tell you that 3 weeks from now, I think we're going to get some more very important information when we hear what the staff forecast is for potential.
And I think there's some interesting market dynamics going on here. And when you worry about the wealth effect that's coming, the negative wealth effect that's coming from the housing sector, it's being made up for by the positive wealth effect.
Sani, looks like stocks are also giving a bit of a verdict here as well.
Yeah, and remember we were talking about that 20%, that small minority down here that felt that the market was a little too complacent, and felt that they were complacent because the Fed might institute or might put in a slightly more hawkish statement on inflation. Now, I agree with what Ron was talking about and Steve was talking about, but the Fed didn't change its commentary on inflation, and I think that's what you're seeing here now. You're seeing a little bit of a relief rally in the stock market because we didn't get the slightly more hawkish statements on inflation that a small minority of people were being concerned about. Right now, the 1389 here on the S&P 500 is now up 13% since the low that we saw in July, Aaron. And this is probably, in fact, I'm quite certain, this is the best single rally that we've seen straight up since the 2003 rally, that great rally we saw. There was two separate rallies in 2003, the first half and the second half of 2003. This is the best rally we have seen this 3-month period since that second half of 2003.
All right. Well, thank you very much to all of our CNBC experts. And as you see right now, we've got the Dow up nearly 15 points after a decline of 30 prior to the Fed decision, and a bit of a rally in the bond market as well. 10-year yield right now 4.775%. Ahead, former Dallas Fed President Bob McTeer going to join us to size up the announcement, and then the two biggest bond fund managers in the nation, a panel of stock experts, and a look at the two biggest economies within the United States. Hint, combined, they are bigger than China. That's still to come today on this special Fed edition of Street Signs.
Welcome to Fast Money, where making money is our game. Mackie, what's a trade?
I like Microsoft.
Adami?
Goldman Sachs.
Strazzini? Bowling?
Missing your Fast Money? Fast Money will be reappearing Friday night at 8 p.m. Eastern on CNBC.
One with President George W. Bush.
What are your priorities in your final 2 years in office?
I want America to be the most competitive country in the world. We're not going to leave Iraq until we get the job done.
Do you use Google?
To pull up maps. I kind of like to look at the ranch.
Only on CNBC, first in business worldwide.
Welcome back to this special edition of Street Signs. The Fed just moments ago leaving its benchmark interest rate unchanged at 5.25%. Little change in the growth outlook, but some saying basically just like changing the date on that statement. The Dow Jones Industrial Average up 3 points, had been down 30 briefly after the decision, hitting a new intraday high of 12,143. S&P, though, we just want to draw your attention to that because while you see a reaction, it was up about 1.6 points prior and is now up about 3.5. So not as much as a move there for the S&P 500. All right, well, right now, the question on the minds of Fed watchers is what the committee... Let's take a look at oil futures. We've got the final trades of the day trickling in, and that has been really a key driver for stocks today. Crude oil, $2 higher. An unexpected decline in inventories is the reason for that. That's a gain of about 3.4%, and it puts crude solidly above $60 a barrel at $61.35. That is a lot of what was moving stocks. Now, take a look at these charts because you're going to see a spike on every single one of them, and that spike is at 2:15 Eastern when the Fed's decision on interest rates crossed. As we told you, in a sense, it could look like the Fed just changed the date on this statement. Rates are unchanged, a slight change on the economic outlook, but no change at all on inflation or in terms of the viewpoint within the Fed, and markets have come back to exactly where they were before the Fed decision. You see that on the Dow. The Nasdaq, in fact, was in positive territory prior to Fed, now in negative, and the S&P 500 was up about 1.6, is now down just slightly. As for the 10-year note, let's show you what we're seeing here, and it is the same issue. You see the move to the downside on yields, but not a whole lot of change right now in the 10-year. I have the yield right now at 4.79%. It was at 4.80 prior. So let's find out how we should interpret this, since clearly the markets need some guidance. The bulls and bears are duking it out at this instant in the bond market. The bulls betting that a slowing economy will force the Fed to cut rates, and the bears, well, they're obsessed with inflation and see a rate hike over the next hill. Right now, bears are in the catbird seat. Rates have risen since the Fed's last soiree. Last Fed meeting, Ken Volpert of Vanguard took the bear stance, so he's made some money.